Hey there, I'm Mike Upland. Most advice you see comes from financial planners, but what about the lessons you learn by doing? Like how a safe mutual fund once cost me $17,000 in taxes. Yup, it's true. And man, was that hard to swallow when I had to pay that into the government, especially as it was so unexpected. It's because of a sneaky trap hiding in a fund I was investing in that I thought was safe. And it had been until this tax surprise literally sprung up on me. And I had no idea it was even lurking there. If you hold mutual funds, even index mutual funds, in a taxable account, you need to hear this. And it's something that you really don't hear a lot about. And I certainly didn't know anything about it, which is why it caught me by surprise. Now, when I first started investing, I listened to many experts, and what I always heard was to invest in index funds that follow an index because they historically outperform actively managed funds. So that's exactly what I did. In my 401k, my IRA, I invested in index funds, and I also opened up a taxable brokerage account with E-Trade when I maxed out what I could contribute to those funds in any given year. And I found index mutual funds that I really liked, and they performed really well for me. There was one index mutual fund that I really liked that followed the NASDAQ index. And naturally, I leaned towards that because all my career I was in IT, so I like to invest in a mutual fund that followed this index. With my investing, I pretty much had it on autopilot. I picked some good index funds and then I just put away as much as I could that my wife and I didn't need to cover our expenses. And eventually that all grew enough so that I could retire early, which I did last year at the age of 55. However, one year as I was doing my taxes, I got a huge tax surprise. I owed 17K in taxes. Of course, I was shocked and I knew I had to figure out what happened, and it was this. And it was something that I was completely unaware of and hadn't heard. Mutual funds, even passive index funds in a taxable account, will force taxable distributions on you when they rebalance. The reason why fund managers rebalance mutual funds is to keep the investment mix in line with the fund's goals. And let me explain by using a gardening analogy. Imagine you have a garden where you plant equal amounts of tomatoes and basil because they complement each other. Over time, the tomatoes grow fast and start taking over, shading out the basil. If you let this continue, the basil might struggle and your garden won't have the balance you originally planned. So, to keep things in check, you cut back some tomato plants to encourage more basil growth because it'll have more access to sunlight. And this way, your garden stays balanced and both plants thrive. In the same way, with the index mutual fund that tracks the NASDAQ index in my portfolio, the fund managers did the same. Since the fund is supposed to track the index, it should hold the same stocks in the same proportions as the index. If there are some stocks in the mutual fund that shrink in value, they might become too small in the portfolio compared to their weight in the NASDAQ index. So, to rebalance, the fund managers buy or sell stocks to make sure the fund continues to match the index. For the fund I was invested in, they did this once a year in December. So, rebalancing is normally a good thing. And when in a non taxable account like an IRA or 401k, which aren't taxed until you withdraw, or a Roth IRA, which is never taxed, it's fine because they are selling stocks out of the fund to rebalance. And those sales don't impact you because you're not taxed on the gains of those funds. However, that's completely different when you have the same fund in a taxable brokerage account. When the fund managers rebalance in those funds, you're going to get taxed on the gains and pay long term capital gains on stocks in those funds you've held over a year, which are taxed at lower rates. and short-term capital gains tax for stocks you've held less than a year, which, yikes, are taxed at ordinary income rates. And the worst part is you have no control over what the fund managers do when they rebalance. You just get hit with the distribution and getting a surprise tax bill you weren't expecting. It's like getting a bill for a party that you didn't attend. So when this happened to me, I was shocked and surprised, but I was not going to let that happen to me again. And it also shows how you shouldn't always go it alone, like I did, and get a second opinion, ideally from a professional, so that you can avoid these kinds of mistakes. So I definitely learned my lesson there. Thankfully, I was employed when this happened and had health insurance through my employer. But can you imagine the potential impact on your subsidies if you're on an Affordable Care Act plan? When the fund rebalances and distributes gains to you, that's income that you're taxed on. So that will increase your adjusted gross income that your subsidy is based on. And it could greatly reduce your subsidy or even remove it altogether if it pushes your income high enough, not to mention potentially also pushing you into a higher tax bracket. So here's what I did. As this fund that I really liked, I was not so happy with it being in my taxable brokerage account anymore, and I certainly did not want to get another tax surprise again. So what saved the day? What I did is I swapped out that index mutual fund with an ETF or exchange traded fund that also followed the NASDAQ index but wouldn't create this surprise tax bill for me when the fund rebalances. Why? It's because ETFs trade like stocks. You are in total control of when you sell them and get gains, and therefore when you pay taxes, which is not the case with an index mutual fund in a taxable brokerage account. Also, ETFs rarely distribute capital gains to investors, so they are just naturally more tax efficient. Whereas index mutual funds, when they rebalance in particular, they can distribute capital gains, which in a taxable account creates a taxable event. And no one likes a taxable event. I certainly don't. So ETFs are the solution. However, I couldn't just swap out the index fund and replace it with an ETF, because if I did that, if the shares had gained in price, I would then pay taxes on those gains, so I had to be very strategic about it. And that's where something called tax loss harvesting comes in. Now, it sounds like a fancy term, but it's not. And no, I'm not referring to another gardening analogy. All it is just selling losing shares in a fund to offset gains or income. So I sold shares in that index fund at a loss when I could. This allowed me to swap out those funds into an ETF that also followed the NASDAQ index without paying any additional tax because I didn't have a gain since I sold them at a loss. If I had been in the situation of having an ACA plan, this strategy can also help in keeping ACA subsidies, as lowering your AGI or adjustable gross income is critical to keeping those subsidies in place to pay for health insurance. The other thing I did in the index mutual fund is I stopped the setting to reinvest distributions and had them go to cash instead. That way, instead of reinvesting the money in that same troublesome mutual index fund, I could move that money into the ETF instead that followed the NASDAQ index as well. And I have to admit, when I did sell at a loss to take care of this, psychologically, it felt like admitting defeat. But as soon as the money sold out of the mutual index fund, which happened after market close, the very next day, I put it in the ETF that also followed the NASDAQ index and was really in the same funds as the index mutual fund. So I was buying into that at a lower price and getting a much more tax efficient fund at a discount. This move I patted myself on the back for because, number one, it got me out of the potential tax bomb that the index mutual fund was. Number two, the loss also offset some of my ordinary income. And number three, The ETF I invested in was better than the index mutual fund, as I learned it had a lower expense ratio that I calculated saved me $520 per year for every 100K I end up having invested. So this move was a win, 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 and bulletproofed my portfolio against these future tax surprises. So there you have it. At all costs, avoid index mutual funds in taxable brokerage accounts. Please learn from my mistake. Go with an indexed ETF instead. This will put you in control and not fund managers deciding what your tax bill is going to be. Thank you for tuning in, and please hit the like and subscribe button if you found this information helpful. It really motivates me to have your encouragement and support to keep putting these videos together. Really more than you know, and I'm so thankful if you do that, and it only takes a second of your time and is no cost to you. And subscribe so I can keep sharing these insights for you of all the things I learned to become an early retiree and the things I'm still learning as an early retiree. And I'd really love to hear from you, truly. If you have a similar experience, let me know in the comments, or any investing insights you've learned along the way. Or if you have some great ideas for my next video you'd like me to talk about, I'd love to hear from you. And when you're on the go, you can listen to Early Retirement Roadmap wherever you get your podcasts, or visit me on my website at mikeupland.com. Until next time, this is Mike Upland. Take care and make the most of today.